Here's a question for you. What if there were a completely legal strategy that allowed the wealthiest Americans to grow their assets indefinitely, access the value of those assets as needed, and ultimately pass them to their heirs, all while paying little to no income tax on the majority of their wealth? You'd probably assume this was a loophole that gets closed eventually, or something that only applies to people with $100 million, or something that requires complicated offshore structures, an army of lawyers. None of that is true. The strategy is called buy, borrow, die. It is entirely legal. It is widely used by high net worth individuals. And understanding how it works, even if you can't apply it in full immediately, fundamentally changes how you think about building and transferring wealth. My name is John, and I spend way too much time thinking about how the tax code creates fundamentally different wealth-building pathways for people who understand it versus those who don't. If you want to understand the tax strategy that the ultra-wealthy use, explained in plain English without political commentary, just the mechanics, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Let's break it down. Section 1. Buy the foundation. The buy phase is the acquisition of appreciating assets, primarily stocks, real estate, or business interests. The critical tax insight here is that unrealized gains are not taxed. If you buy $1 million of stock and it grows to $5 million, you owe zero tax on that $4 million gain as long as you don't sell. The gain exists on paper, in your net worth, but not in your taxable income. This is the foundation of the entire strategy, building wealth in a form that does not trigger income tax, simply by existing. Section 2, borrow, accessing wealth tax-free. Here's where it gets really interesting. If you need cash for living expenses, for a business investment, for anything, you borrow against your appreciated assets rather than selling them. You use the stock or real estate as collateral for a loan. The loan proceeds are not income. They are not taxable. You receive cash. You pay no income tax on that cash. And you never trigger the capital gains tax by selling the asset. The loan is repaid through future borrowing, through other income, or strategically, not repaid during your lifetime at all. The interest on a loan is typically lower than the capital gains tax you would have paid on a sale, making the borrow strategy financially superior to selling in many situations. Wealthy individuals do this at scale, borrowing hundreds of millions against portfolios worth billions, living on the loan proceeds, and never triggering a taxable event. Section 3. Die the step up in basis. Here's the most powerful and most controversial part of the strategy. When you die, assets in your estate receive a step up in basis to their fair market value at your date of death. This means the entire unrealized gain that accumulated during your lifetime, the gain you strategically never triggered to the borrow phase, is permanently erased for your heirs. Your heirs inherit the assets at their current value, not your original purchase price. Any loans against the estate are repaid from the estate's assets. And the multi-generational accumulation of unrealized capital gains simply disappears. This is not a loophole. It is the intended operation of current estate and tax law. Section 4. How ordinary people can apply this. You don't need $100 million to apply the underlying principles of the strategy. By appreciating assets, index funds in taxable brokerage accounts, and hold them rather than selling. Avoid triggering capital gains unnecessarily. Utilize tax advantage accounts, Roth IRAs and 401ks, where growth is tax-free or tax-deferred. When you need cash for major purchases, consider whether a securities-backed line of credit from your brokerage is more advantageous than selling assets. Keep your estate documents updated and review beneficiary designations annually to ensure your assets transfer efficiently. The buy, borrow, die strategy illustrates something important. The tax code is not neutral. It rewards certain behaviors, holding assets, borrowing rather than selling, building intergenerational wealth, over others. Understanding the incentive structure of the tax code allows you to align your financial behavior with those incentives at whatever scale you're operating. If this explains something you've been hearing about but didn't fully understand, hit the like button and subscribe. Every week we demystify the financial mechanics that most people find opaque. I'll see you in the next one.